Hello, my name is Brenton Harrison with Ultra Borrowers Academy, an online course where we help people with a mountain of student debt take back control of their loans. And today we're here to talk about a concept called interest capitalization, what it is, how to avoid it, and how it impacts your student loans. Let's get started. If you have federal student loans, especially if you have a lot of federal student loans, it's highly likely that at some point a loan counselor, a professor, a financial professional has told you to avoid having the interest capitalized on your federal student loans. And it's presented as the worst thing that can happen to you financially. And make no mistake, it is damaging. But to me, it's only instructive if you actually know what interest capitalization is and why it's so damaging to your student loans. For many people, the disconnect in understanding what interest capitalization is that they don't understand the difference between how most loans work in terms of how they accrue interest compared to federal student loan interest, which is very, very different. For many people, when they look at federal student loans, they assume that, like many forms of other financial debt, interest accrues on federal student loans at compound interest. Compound interest is essentially a tool, it's a financial tool or financial concept where the interest that accrues on a debt is added to the previous interest each year. I'll break it down a little easier. Let's say that I have a person whose name is John Doe and he borrows $100 at 5% interest. When they calculate John Doe's interest in the first year, it's going to be 5% of the $100 that he borrowed. $105 is going to be his loan balance at the end of the year. 5% on 100 is $5, and they add that $5 onto his loan balance. Now, when compound interest comes in, is where in year two, when they're calculating the 5% that he owes on his loan, it is not going to just be based on the original $100 that he borrowed. Instead, it will be based on $100 and the $5 of interest that was added in the previous year. Compound interest is interest growing on top of previously accrued interest. So instead of 5% on $100, it's now 5% on $105. And whereas if we had done it differently and just did it off the original loan balance, his loan balance at the end of year two would have been $110. Because of compound interest, it's now $110.25. Now, the longer the compound interest grows, the more damaging it can become, because when that loan balance gets really high, now that 5% is being calculated off a higher and higher and higher number, and it becomes very easy to your debt to spiral out of control. I'll show you an example with a larger sum where instead of borrowing $100, let's assume that somebody borrowed $100,000, and that loan is going to compound at 5% interest. Well, in year one, it's 5% on the original $100,000. So it's $105,000 at the end of the year. But in year two, they calculated off of the $100,000 plus the $5,000 of previously accrued interest. So the new debt is $110,250. By the end of year three, the debt is basically $115,764. Whereas if we hadn't used compound interest and had basically calculated that interest off of the initial loan balance itself, it would only be $115,000. So essentially, just in 3 years, this person has cost themselves an additional $750 some odd dollars simply because of the concept of interest growing on top of previously accruing interest. Now, the reason this is so important is because if you have a ton of student loan debt, there's a high probability that you're paying that debt back using what's called an income-driven plan. And we've covered these ad nauseum, but an income-driven plan is a federal repayment plan where the payment that you make is based on a percentage of your income instead of being based on the amount actually needed to pay your debt and interest off in full. So you have people with income-driven plans who may owe $400,000, but when they do the calculation for their payment, it may lead to them only paying $50 a month. Well, if you're only paying $50 a month on $400,000 of debt, not only are you not going to pay that debt off in full, you're not even going to be covering the minimum interest that's accruing. Again, if we did this with compound interest, every single time that interest accrued, it would be added on to your initial loan balance and whatever previously accrued interest was there as well. But with federal student loans, interest accrues at simple interest, meaning that when you have interest accrue on your debt, it's set off to the side, and the next year when they calculate interest, it is based on the initial loan balance. Let's look at this in action and take that same person who borrowed $100,000 and instead put them on an income-driven plan with a federal student loan. Now, the first year, they have 100,000 in loans, and you see that $5,000 of interest is accruing. That interest is put in a separate category, and this is why on many of your loan statements, you see two categories, the loan balance itself and also an interest category. Because in year two, when they calculate 5% interest, it is off of the initial $100,000, and they put the new $5,000 in a separate category as well. In year three, it's the same, and so on and so forth. So in this person example, you would see that at the end of year three, they would have a $100,000 loan balance and $15,000 of total interest that is accrued in this separate category. Now, it's not like with this concept, having federal student loans is suddenly an enjoyable thing, but it does mean that as long as you can keep the loan balance and the interest categories separate, that over the course of time, you'll actually pay a lower and lower percentage of interest on your total debt, which is not the same as a compounded loan. Again, in this example of a compounded loan, at the end of the third year, the amount of interest that you see has increased from the first year because it's being calculated off of this person's total debt. It's 5% on not just the initial loan balance, but also all of the interest that accrued in previous years. But with federal student loans, by keeping the two categories separate, it means that each year that 5% in this example is only accruing off the initial loan balance, which means that it's actually not 5% of this person's total debt. By the end of the year three, this person actually owes combined $115,000, but the $5,000 of interest that's accruing is actually not 5% of their total debt. It's actually a little over 4%. And as that concept continues to grow and grow and grow and grow and grow, you can see why if you had to have a compounded loan versus a federal student loan, you would much prefer this simple interest that's being accrued with a federal student loan. Now, here's where interest capitalization occurs. Interest capitalization is when a certain series of events can happen that can cause these two categories to be merged. And the separate interest category is then added on to your loan balance. And now you do have a higher amount that's accruing based on the interest rate listed on your loan. So this is what people are referring to when they say your interest has capitalized. Instead of you getting the benefit of keeping your interest in a separate space and having that interest accruing off of just the initial debt, you now have the entire balance growing at a rate of return that can be really damaging to your student loans. I'll show you an example of a capitalized loan versus one that is not capitalized. Here's one that's just like the example we showed before with an income-driven plan. We have 100,000 of student loans growing at 5% simple interest. You have 100,000 as the balance, and each year 5% of the initial loan is what's being added to the interest category. But if this person has had their interest capitalized in year four, you will actually see that instead of in the previous year having the loan balance and the interest separated, we have actually added what was in that interest category onto their loan balance in year four. And now 5% is being calculated off of 115,000 instead of the initial 100,000 that it was before this interest capitalized. So you can see this concept, and you can see why if you have a tremendous amount of interest capitalized onto your loan balance, it can certainly be damaging to your student loan. Now, the reason people have told you and warned you about interest capitalization is because there's actually a certain series of events or certain actions you take that can cause your interest to capitalize. Some of them you can't avoid, but others you can. And if you know what those things are, you can make sure that you don't do anything to adversely impact the interest that's accruing on your debt. So let's go through the things that cause your interest to capitalize. The first is if you exit a grace period or deferment or forbearance, the interest on your loans will automatically capitalize. You cannot do anything to avoid it. And this includes when you're in-school deferment. So when you leave school, whatever interest that's been sitting off to the sidelines, if you have an unsubsidized loan, that will automatically capitalize onto your loan balance. But the same is true if you go through a period of deferment or forbearance as well. We talked about income-driven plans, but there's a good reason why, if you can, you want to pick an income-driven plan and stay with it, because when you switch income-driven payment plans, you will also see the interest on your student loans capitalize. So we see people who switch back and forth from year to year to year. You want to make sure you're doing it for good reason, because every single time you do that, the interest on your loans will capitalize. Now, with two of these plans, the income-based repayment plan and the pay-as-you-earn plan, you can actually lose eligibility. There's certain metrics that you have to hit where if you earn too much and you don't have a proven hardship, you can lose your eligibility to participate in those plans. And if that happens, you will also see the interest on your loans capitalize. And under all income-driven plans, since they are based off of a percentage of your income each year, they require you to do what's called a recertify, which means once each year you have to send in updated pay information so you can let them know what you're earning. And if you neglect to do that, if you neglect to certify your income for an income-driven plan, the interest on those loans will also capitalize. And then lastly, if you have all these disparate loans that you're trying to put under one umbrella by consolidating them, or if you have federal student loans that you're refinancing with a private lender, when you go through that process, that separate interest will be added onto your loan balance and the interest will capitalize as well. I hope this video did a better job of breaking down this concept if it's been something that you haven't understood in the past. Having your interest capitalize on your student loans is definitely something that you want to avoid if at all possible. But there are some reasons, like having a good refinancing opportunity, like if your financial situation has changed and you do need to be on a different repayment plan than what you were before, or even the unavoidable may be something that in the long term makes sense for your loan strategy. If you're looking for a loan strategy or just want more content about some of the stuff that we're discussing, I invite you to do a few things. Subscribe to our channel and subscribe to the notifications so you know when new videos are being posted. And also go to Ultra Borrowers Academy at ultraborrowers.com, where you can check out the content for our online course and see if you need to become the next member of Ultra Borrowers Academy. Talk to you soon.